Welcome to the pit. I'm Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. 615,000 Singaporeans are about to receive a windfall of 6,800 Singapore dollars in SINGTE'Ls shares, and most of them will lose money feeling completely safe. Today, we are auditing the 22% valuation premium the market is hiding from you. The market wants you to hold these shares out of nostalgia. But smart money is looking at the actual data. If you are relying on this for your retirement runway, you are about to misallocate your capital. We are going to break down the hard forensic numbers to show you exactly why holding this stock right now is a trap that could actively shrink your wealth. Looking at the core yield, we see 3.7%, and that is actively shrinking your capital. When you compare that against the CPF risk-free floor of 4.0%, which is guaranteed with zero market risk, you immediately see the gap. SINGTE'Ls is currently the most popular way for older Singaporeans to lose money while feeling safe. If you hold these new shares just because of nostalgia, you are funding a corporate dividend policy that cannot even beat the government's basic interest rate. That is a terrible trade for your retirement. Let's look at who we are and why we look at things this way. Before we get deeper into the numbers, let's talk about the kind of investor you are. You are not here for the kopi tips, the market hype, or the noise. You are here because you want the forensic truth before you commit a single dollar to the SGX. That tells me you are serious about protecting your hard-earned capital. The elite investors in our community understand that relying on old familiar names is not a strategy. We audit the data directly, without the emotional attachment to find out what is really going on beneath the surface. The algorithm only sees one signal, and every forensic investor who reads or watches without subscribing is invisible to the machine. If this analysis has helped you identify a risk in your portfolio, subscribe for free and share this with one person who needs to hear it. It is the only way to tell the algorithm that data-driven SGX analysis deserves a seat at the table. We need to push back against the standard retail traps, and your support helps us bring institutional-grade auditing directly to the heartland investor. Now let's move to the health check. Step 1 is the health check. And right away, we have a yield trap alert. Looking at the financial health checklist, the trailing 12-month dividend yield sits at 3.7%, failing our minimum hurdle of 4.7%, while the net gearing at 26.7% and interest coverage ratio at 18.1 times both pass with flying colors. The price-to-book ratio is 3.01 times, failing against the sector median. Before we even look at the profit, we must audit this foundation, and the structural metrics are flashing warning signs. When we look at the Fortress balance sheet, we see sputtering returns. The forensic verdict here is nuanced. SINGTE'Ls does not have a debt problem, it has a productivity problem. The gearing at 26.7% and an interest coverage ratio of 18.1 times mean they are safe from financial distress. But the return on that capital is weak. With operating margins at the bottom of the peer range, the market is charging a significant premium for a business that is fundamentally underperforming its operational potential. Moving to the forensic dashboard from Investing Pro, the models show a fair value of 4 Singapore dollars and 3 cents compared to a market price of 4 Singapore dollars and 93 cents. That represents a significant downside risk of over 18%. The financial health scores across 5 dimensions clearly indicate that the current price is not supported by the underlying fundamentals. The consensus from 15 independent analysts might point higher, but our forensic fair value model cuts through the noise to show you what the cash flow actually justifies. The platform gives this a relative value score of 1 out of 5. Is your yield a trap? You always need to check the health score before you buy. That score is not an opinion, it is a quantitative signal that the market is charging a premium the fundamentals do not support. This is the exact same data infrastructure that institutional desks use, now made accessible to the heartland investor. If you want to lock in your edge, you can use the code on screen for a discount. Let's break this down into our 5-layer audit. Applying our 5-layer forensic audit, the raw fact is that SINGTE'Ls trades at 4 Singapore dollars and 93 cents with a 3.7% yield. That sits 100 basis points below our 4.7% benchmark. In peer context, DBS clears at 5.3%, making SINGTE'Ls structurally inferior for retirees. In a forward scenario with a 10% cost shift, margin compression pushes the effective yield toward 3.3%. Finally, the wallet impact means losing 20 Singapore dollars and 40 cents annually on your windfall, while taking on 100% more market risk. Let us apply some simple Kopitiam logic here. If your hawker stall is fully paid off and earns $3.70 for every $100 you put in, while the post office bank next door gives you $4 for doing absolutely nothing, you do not have a business. You have a hobby. SINGTE'Ls' interest coverage ratio means they are safe from bankruptcy, but safety is not the goal. Sanctuary is the goal. Sanctuary is where your money grows faster than inflation without your principal being at risk. For our stress test floor, we audit for the storm, not just the sunny day. I apply a conservative floor of 3.2%. Yes, the recent T-bill rate dipped to 1.37%, but that is a temporary dip, not the standard. We do not lower our standards to match temporary market fluctuations. Our minimum yield hurdle remains at 4.7%, which is the 3.2% floor plus 150 basis points of mandatory risk premium. Singtel simply cannot clear this bar. Step 2 is the wealth check, where we separate the sugar rush from the daily bread. Look at the dividend trajectory table. The elevated yields in financial years 2024 and 2025 were value realization dividends, which are one-off asset sales. You cannot fund a 20-year retirement on one-off sales. The estimated total payout for financial year 2026 is roughly 14.8 cents, putting the yield around 3.7%. But when you look closely, that still includes a 1.8 cent special dividend. This is where the illusion is unmasked. The total yield at 4 Singapore dollars and 93 cents is 3.7%. But if you strip out the special value realization dividend, the core yield that remains is only 2.6%. Now factor in the risk premium. 3.7% minus the 1.37% T-bill gives you a premium of just 2.33% to take equity risk. You think you are getting a 6% stock, but you are actually holding a 2.6% stock dressed in a 3.7% jacket. This brings us to the asset-light mirage. The market is cheering Singtel for selling the family silver like towers and data centers, but they can only be sold once, and then Singtel pays rent permanently. This turns a capital expense into an operating expense, thinning margins structurally. The dividend spike today equals a reduced earnings engine tomorrow. A leaner balance sheet does not help if the business cannot outrun a T-bill. Do not mistake a liquidation sale for organic growth. When the towers are gone, what remains is a telco paying rent to survive. Before we move to the price check, if you want zero-day access to these forensic models before the market moves, check out Iggy's Elite Investors using the link in the description to get the exact elite tools we use to audit these yields. Now, looking at the forensic gap peer table, the discrepancy is stark. Singtel's model value is 4 Singapore dollars and 3 cents against a price of 4 Singapore dollars and 93 cents. Meanwhile, StarHub offers a 6.0% yield but carries a 49.5% debt to assets ratio. NetLink offers 5.44% with a safe 23.0% gearing. That gap represents a 22% valuation premium, which we call the nostalgia tax. You are overpaying by 90 cents per share. While 15 independent analysts have a consensus price target of 5 Singapore dollars and 35 cents, that is a 12-month price target, not a forensic income assessment. For a retiree building a distribution portfolio, a potential 8% capital gain means absolutely nothing if the yield cannot clear the CPF retirement account rate today. You are paying a heavy tax just to hold a familiar brand name. This is the MRT door paradox. StarHub is a yield trap with a 6.0% yield but a broken balance sheet sitting at 49.5% debt to assets. NetLink NBN is the forensic alternative, offering a 5.44% yield with a fortress-grade 23.0% gearing, and it owns the physical fiber Singtel depends on. Everyone crowds the Singtel carriage because it is familiar. The NetLink door is wide open, clears the yield hurdle and has a fortress balance sheet, yet retail investors ignore it because their father never mentioned it in 1993. Step 4 is the capital allocation test for the 615,000 seniors receiving the 6,800 Singapore dollar windfall. If you hold Singtel, you earn about 251 Singapore dollars a year at 3.7%, but risk a 1,238 Singapore dollar capital loss if it reverts to fair value. If you top up your CPF retirement account, you get 272 Singapore dollars a year guaranteed by the government with zero market risk. If you pivot to NetLink, you generate 370 Singapore dollars a year with fortress parameters. You have to know your profile. For the accumulator at age 53 with a longer runway, you can accept some volatility, making NetLink or a money market fund rational choices while waiting for the forensic gap to close. But for the drawdown investor at age 63, there is no runway to recover a capital loss. The CPF retirement account top-up is the cleanest forensic answer, as the guaranteed rate clears the floor and the principal is inviolable. There is no scenario where a 3.7% equity at a 22% premium beats a 4.0% guaranteed instrument for a retiree. Most investors will do nothing. The shares appear in their account, they feel wealthy, and they move on. This is inertia risk, and the market is specifically designed around it. The psychological anchor of a familiar name is the most expensive luxury in a retirement portfolio. If you would not take 6,800 Singapore dollars of hard-earned savings and buy Singtel today knowing fair value is 4 Singapore dollars and 3 cents, you should not hold the shares they just gave you. Inaction is a choice to buy at the top. The gap between the CPF retirement account and Singtel is 21 Singapore dollars a year on your windfall. That sounds small, but over 10 years, that differential compounds into thousands of dollars of compounding cost before you even factor in any capital loss from valuation reversion. The psychological comfort of a blue chip name in your CDP account is very real, but it is also a comfort fee you pay the market every single year for the privilege of feeling safe while actually earning less than the risk-free rate. The forensic verdict is clear. This is a yield trap. Singtel is a legacy telco trading at a 22% premium above its forensic fair value. The core yield of 2.6% simply cannot clear our 4.7% hurdle, and it cannot even beat the CPF retirement account. Your capital belongs elsewhere, either in the CPF retirement account or a high-quality money market fund, at least until this forensic gap closes and the core yield can safely clear the threshold. The bottom line rule for any distribution portfolio in this market environment is very simple. Protect the principal at all costs. Audit the yield rigorously against the risk-free floor, and absolutely ignore the familiar brand name. If you want the full breakdown and zero-day access to our forensic models before the free version drops to the public, Iggy's elite investors get all the actionable intel first. The 7-day embargo window is strictly enforced, so if you want to front-run the retail crowd and protect your capital, hit the link in the description to join Iggy's elite investors today. This content is for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security. All investments carry risk, including potential loss of principal. All data is sourced from public filings, and unverified data is explicitly flagged. For CPF, SRS, or personal capital decisions, please consult a MAS licensed financial advisor.